The headline findings of this year's PwC Mine Report, I guess, are in the heading, the gloves are off. And so there's been a lot of debate and players against each other, but also government intervention. And so it's a good news, bad news story. So I'll give you the bad news first, because I'm a good news guy. The bad news is, unfortunately, market cap fell 16% again this year for the top 40. So that's 156 billion wiped off in market value. And on top of that, we saw a slowdown in capital expenditure. The good part of that is, though, financially, the mining industry is in a lot better position because we actually managed to deliver on our cost-saving promises, and so that came through in better free cash flow, which went from minus 3 billion to over 20 billion positive cash flow, mostly from reductions in capital expenditure, but some good, diligent, CEO-focused cost reduction targets, and also looking at where they want to spend their projects and programs. So in an Australian context, the three, I guess, surprises that stood out for me, one was around return on capital employed. So this year, unfortunately, it was down from the total top 40 to 8.4%. But when you dive below it, return on capital employed for the iron ore players, which is obviously relevant for Australia, still stays at 9%. So even though there's been a lot of pressure on commodity prices, particularly in iron ore this year and some volatility, just shows that it is still a very good business. I've mentioned the volatility part, and that has just wreaked havoc through the industry over the past 12 months. Particularly, gold's been relatively steady, but some of the other commodities have really been all over the place. And so for the Australians, particularly at, I guess, the lower end of the top 40, and beyond that for the Australian businesses, really tough to manage cash flows, their focus on margins, and being more nimble, being able to scale up and scale down production and people is going to be a real challenge for the Australian miners. The second part is in relation to exploration. And unfortunately, we've seen a drop in exploration spend, 59% across 2 years. And so, particularly in Australia and the more juniors, that has ongoing implications because the money's being spent on brownfields, so developing existing mines, as opposed to the greenfields. So where are the future mines going to come from, particularly in Australia? The third point is the shareholder part. And we've seen continual pressure, stakeholder activism, but for shareholders, the dividends are an amazing story. So whilst the market caps have been falling, the dividend payouts are now up to 5%, which is incredible for an industry that is typically cyclical. And again, it's the iron ore players, or the big end of town, they're even higher than that, 6%. And that's against a 10-year average of 2.8% in dividend payouts. So what does this mean? Well, can we continue paying this level of dividends to shareholders when we know that developing mines takes a long time and it's a cyclical business? So those three things stick out for me, something for the Australian miners to watch for. Volatility and how they respond to that, the future mines through exploration, and what do we do in relation to our shareholders and how we pay them back.
Governments around the world have been focused a lot on tax transparency as fiscal budgets globally come under challenge. And we're not immune from that in Australia. Certainly the Australian government relies very heavily on revenues generated from tax payments from mining companies. And in line with our theme about the gloves are off this year, one thing that we've seen a lot is a lot of community activism around companies paying tax and are they paying their fair share of tax. And certainly the mining industry is not immune to that. We've had in Australia a Senate inquiry into tax avoidance, and certainly the mining industry was well represented at that. There's a real push in understanding, firstly, how much tax mining companies pay. And so in Australia, we've seen just recently in this year's federal budget a raft of measures announced which will require large mining companies, large companies in general, those with a turnover over $1 billion, to identify for the government how much tax they pay in each country and what types of resources they have in each country. How many people, how many assets, the dollar value of their profits, as a real first step on the part of government to identify if organisations are paying the right amount of tax. The federal government's budget is very heavily reliant on corporate tax revenues, and in particular from the mining sector in Australia. And so a write-down of profits from mining companies is really going to impact the federal government's bottom line and ultimately the services that government can provide. We've got a scenario now where there's long-term government deficits forecast. And so mining companies with a fall of commodity prices, obviously are paying less taxes, both at the federal level and also at the state level in terms of royalties. I think the response to this will be really a focus on government on changing how it collects tax, the types of things that it taxes. And so to that end, we are seeing the government that having released a discussion paper. Later in the year there'll be a white paper released which will look at tax reform more broadly. And I think that will start to move us in the direction of relying less on corporate income taxes and therefore less exposed to the commodity cycle in terms of the revenue that federal government generates.
Globally, there's about $10 to $15 billion worth of private equity investment looking at the resources sector. So these are funds such as X2, RCF, EMR Capital, and a number of others. Those private equity investors are generally patient, but now and for the next 2 or 3 years, it's their time to consider the sector very seriously and to look at some real investment opportunities. With commodity prices being relatively low and a subdued outlook, now is the time for those patient, longer-term investors to invest. Now, they're not going to be frivolous and deploy capital in a reckless way. They're going to be very disciplined. They're going to be looking for long-life assets. They're going to be looking for low-cost operations. They're going to be looking for favourable jurisdictions. And it's a globally competitive environment, so Australia will need to compete on an international scale with many other countries, of course, for that capital. So private equity is a source of capital. It's not a solution for every single sort of undeveloped project or investment need in the market.
This really does, in a nutshell, tell us where the industry is today, because the gloves are off, and it's on so many different levels, and some of this has been brewing for a number of years as well. The gloves are off because we've got activism from shareholders all over the place. One, they've helped remove a number of CEOs over a number of years and wanted mining companies to knuckle down, focus on getting cash back to the shareholders. So that activism has continued on. We've also got the activism, though, of shareholders and other stakeholders not wanting mines to happen in their backyard. We also see it in so many other areas as well, where coal are getting shareholders saying, do not buy into coal. So the gloves are off there as well. There's also, though, governments all around the world now. Governments are finding that their budgets aren't quite stacking up as they thought they were going to stack up. So they're going to mining companies and wanting more. So the gloves are off there as well. Government's demanding more from them. And then you've got the third area of companies actually turning on themselves, which is why it's turning into a brawl. Now, a lot of this stuff isn't particularly healthy for the industry, but in this country, we've seen it in iron ore. There is not only one view out there of what iron ore should look like, as we've seen in this country, as I say. It is fascinating. Where to from here? What we do need is the industry to actually get a bit more cohesive, because it's not in anyone's interest to have this brawl in such a public space, but that's where we are today. There's been a lot of focus on cost cutting in the industry really since times started getting a bit tougher, let's say 2 years ago. Really, the key word needs to be productivity, not cost cutting, but inevitably, first up you go for the easy costs. I think what we actually see in a report this year is a bit disappointing. we were probably expecting and hoping that we would have seen a deeper cut to that cost base, but the reality is a lot of the low-hanging fruit has been taken out easily, but thereafter we haven't necessarily seen the productivity gains which we would have been hoping for. What we have seen is a much lower oil price has been very beneficial to the mining companies, and typically a lot of the mining producing countries have seen their exchange weaken against the US as well, which has been beneficial for their costs as well. So we've seen a 5% decrease in cost. Nice, but we probably should have seen more. So I think this game's still got a long way to play out. So 2013, 2014 have been very tough times for the mining industry. Obviously the key question is what lies ahead. Are we going to see better times, or are we in a long-term downtrend? Because as I say, we can't avoid the fact it's been a nasty couple of years. Starting point here is what drove the boom in the first place, which we all enjoyed so much from 2002 up until a couple of years ago. That was the emergence of China. But actually it really wasn't. It was the start of the industrialization, the industrial revolution for 3/4 of the world. That started, well, we started seeing the impact from the metal side about 2002 when it got enough steam to really make an impact. China has slowed down its economy the last few years, really since they had their political changeover and Xi Jinping became the new president. What he's actually done, though, is not really slowed things down. He's changed the economy around and he's making it far more sustainable. Now, he's doing that by, frankly, moving it from being an infrastructure build, an export-led economy, to a domestically led economy. Now, that is fantastic news, frankly, for the whole world, because it makes the Chinese economy already starting to look an awful lot more stable than it did a few years ago. The negative for that is, from the mining sector, there's no doubt it stopped some of the increase in demand which we had got used to. So that's part of why we've had the two nasty years. Gut feel, China's still going to go beautifully well. It's not going to be the same metal intensity perhaps as we got used to, but don't forget it's the industrial revolution of 3/4 of the world. There's a hell of a lot of other people who are still trying to get on the journey, and they're going to need to build things in India, in Indonesia, in Thailand, in Malaysia, in all these other countries which are going to have this fast growing middle class or want that to happen. So the long-term metal drive is still going to absolutely be there. So I'm very confident on future of demand. The supply side of the equation, there's been 10 to 12 years now since we started on the boom. So mining companies have had their time to be able to organise themselves and get new supply up. And we have certainly seen the impact of that, particularly iron ore, which we're used to here in Australia, but in some of the other ones as well. But excluding the bulks of iron ore and coal, I'm not convinced there's been quite as much new supply as perhaps gets talked about. So I still remain very, very confident that we're going to have a very good long-term future into this mining sector. Now, you do need to look commodity by commodity, as you always have done, and some where there has been a bigger supply response may find it harder to outperform compared to some where they haven't. But still, overall, I'm still very, very positive.